Good afternoon. My name is Don Vivrette. Welcome to the It's Your Money session. Today's topic is equity investing, a better approach. The picture, if you're wondering about it, behind me was from yesterday, Monday. On one side of me is the smoke, on the other side is clear sky. It happens to be the view straight out from our patio, and it was interesting to me that there was a very hard line between Newport Beach is bringing us the smoke, and the city of Laguna Beach is bringing us fresh air. So anyway, I just thought I'd put the picture up because I thought it was interesting. The process we're going through is there's roughly 300 of you who have enrolled in this. The question keeps coming up, and I'm going to cover it again, that the website is materials@itsyourmoneyandestate.org. There we'll have the handout material will be there, any material, including on the not-for-profit that we'll show later on. There is handout material there. You cannot turn on your audio or your video. Question and answers will be handled through the normal process of Q&A, and the video will be available tomorrow or the next day for your review and take a look. So now what you can see is, so you pick which of the videos you want to watch, and you can see them. There are 121 people that had actually watched this video that I'm pointing at right now. The other item that comes up is what are the charities and how can we find out information? So there's a list of the charities, and if you click on those, you go to their websites and can see that information in terms of what's going on. Last week, we had a discussion about care, and there was a question of why didn't we put some material on the website? We can't. It's copywritten, it's private, but if you go to coalitionccc.org, you can get the information. There may be a little bit of effort at times, and as you'll see, this is complimentary use through October 31st is what it says. So there's a couple of interesting parts with that, but that information is available from them. We cannot download it and put it on the website. So I just wanted to make sure that I circled back and covered that issue with you. So this week we're doing investing and a better approach. Next week we'll talk about equity investing this time. Fixed income is next week. And if you're with us tomorrow, we're going to talk about retirement account planning. So that's where we are today and where we will be tomorrow. As before, these are the locations that normally we would be attending at, and there's the information as to where they are. We thank them for the times we've been there with them in the past and truly want to be there with them in the future. Participating charities, these are the participating charities that we have had and have at this point. Again, as before, Chapman, 10 years, and I thank you. So we're calling them out and supporting them and thanking them very much in terms of continuing for 10 years to support this series of seminars. That is, as you can, tomorrow, if you watch the video with us, David will talk about why these seminars are important in terms of education. So with that said, normally we would have someone walk in and talk to us about this is the presentation that they would make on their particular charity. In this case, it's Bluebell Foundation for Cats, which is in Laguna Canyon. And so what I'm going to do is switch from this, and I'm going to go pick up the video, just this, click, click, go. And, whoop, gotta move something. Sorry, hang on, don't go away. There.
Bluebell offers loving lifetime care for senior cats whose owners are not able to care for them. For more than 30 years, the Bluebell Foundation for Cats in Laguna Beach has provided peace of mind to hundreds of cat owners and the cats they have entrusted to us. Every cat at Bluebell enjoys personalized care and cage-free community living. Their cottages are surrounded by lush gardens and the beautiful Laguna Canyon foothills. Each cat receives their own individualized meals and the very best health and medical treatment. Life enrichment plans also contribute to their well-being. Bluebell is managed by a full-time staff of cat caregivers. Our dedicated volunteers complete the team at Bluebell and provide the most important service of meeting the unique needs of every cat. That includes back rubs, brushing, game playing, and celebrating special occasions. Learn more about Bluebell's Lifetime Care Program, making a donation to our Veterinary Care Endowment Fund, or including us in your estate plans. Please call us at 949-494-1586 or visit our website, bluebellcats.org. Just like home.
Okay, Pete, would you care to, as soon as I find my mouse here, there you go. Pete is going to join us. Pete
Yes.
is going to join us.
Oh,
So for the group, I have to tell you that about an hour ago, Pete sends me a note that said, I've had a power failure. I can't connect to the internet. Therefore, we're going to make believe in terms of what we did. Pete's back. So just as a cover for you, that's what we've seen here. So,
yeah, I don't know how it turned out on your camera, but or the Zoom video, but Bluebell loudness as compared to our voices got three times
it's what they
louder.
gave us. It's what they gave us. So
yeah, I know. I just wanted to.
So you're
yeah,
exactly.
exactly.
So if you want to talk about Bluebell, go for it. Before you do, however, I'm going to say, okay, group. So if you click on your screen or move your mouse or something, you'll find a little Q&A. If you bring up Q&A, type messages to us and I will get those and ask questions. Either I'll answer them or I will ask questions along the way of the presenters and we will get this covered. So I'm going to disappear and leave this to Pete.
Thank you, Don.
Yep.
Welcome, everyone. Yeah, I just, in fact, used Bluebell Foundation about a month ago with a lady who had to go into the hospital and she had 2 cats at home. And so they're just wonderful. Cats love it. They have a home type setting and they do just an amazing job. So thank you, Bluebell, for being a sponsor, and it's good to give, you know. Yeah, they're a wonderful organization. Today, we're going to talk about equity investing. Don, do you want to, John, you want to bring up the outline, and Kurt, you want to come on board as well? And while we do, I'm just going to give a kind of just a brief review where we've been. And the first session, we had a quiz and just to see, you know, how well you do. We're considered a nation of financial illiterates. We're about scale of Botswana as literacy and finance goes. And it's hard to, when I was working at not-for-profits, and to talk to individuals about their money and about leaving money to a charity, if you don't understand the financial services industry and annuities and the salesmanship that goes on. And so, and also, you know, that you need to take care of yourself first. So in the second week, we talked about the products that are out there that they're trying to sell. Hopefully you avoid those. And then we got into how you should be doing it, and that's putting a financial plan together, knowing what your budget is, knowing your net worth, knowing what kind of risk you want to take, understanding your goals and objectives. And then once you have that kind of understanding, then you go into the investment world. And we talked about investments in a general category. And then last week we had the medical care planning, and medical care planning is really important because you need liquidity. So you need to prepare and have at least $300 liquidity, or you have to get some type of insurance. So today what we're going to do is we're going to focus in on the equity portion of your portfolio. And we have John Pritchard and Kurt Beinfor, who are part of Knightsbridge Wealth Management. So, John, who do you want me to introduce first, you or Kurt, or does it matter? Who's asked first? Okay, pull ask first form, please. And you have a master's or other advanced degree. Where is that from, John?
My master's is from Boston University.
You're a Bostonian, huh? How long did you live in Boston?
I actually did it online from California. So.
Oh, really?
That's it. Entire life in California.
And how long have you been in the financial services industry?
Almost 25 years now.
Okay. You're the first chartered financial analyst that we've had speak. There are about 150 designations in the financial system. Most don't mean much. Tell us why CFA is an important designation.
It is important for those who wish to build individual portfolios and want to research individual securities. And the Chartered Financial Analyst designation requires passing 3 exams. It's a difficult exam, low pass rate, and it was something I'm pleased I did early in my career because it helped me really learn accounting and financial statement analysis. So it's designed for those that really do want to get in the weeds on the investing work. And
so it's a 3-year course, or it's give us a little bit of time, and what is the pass rate for a CFA?
The pass rate, I did this in the 1990s. I don't think it's changed. The pass rate was below 50%. It was maybe 35, 40%. And back then you could only take it once a year. So it was self-study, so you wanted to make sure you passed.
Yeah, the CFA and the CFP are probably the 2 designations in the financial services industry that deserve a good reputation. Notice that you don't have any relevant licenses. Why?
Don't need them. We here at Knightsbridge are registered investment advisors, so the SEC, Securities Exchange Commission, oversees us.
And so you don't sell any product?
No, we charge an advisory fee, an annual fee.
We'll get into that in a second, but talk a little bit about your firm. Give us the highlights and how long you've been in practice.
Sure. Knightsbridge has been around since the mid-1990s. I was a co-founder involved in starting it, and we work with individuals and families, assisting them with their investment needs. That might include financial planning. It might include fixed income investments or equity investments. Today, we're here to talk about the equity part of things, but we are comprehensive in how we build portfolios depending upon what the client needs.
And so you don't practice law. The business relationship, you are a fiduciary, and everyone in the firm operates fiduciary capacity. That's
right. That's really important. We have that fiduciary duty to put our clients first.
Yeah. Isn't that amazing that that 95% of the industry handles other people's money, and most of them are not fiduciaries? Yeah. It's just amazing to me. Compensation, how are you paid?
Clients pay us a fee, an annual fee we apply quarterly.
And do you have a minimum?
$250,000.
And what is your percentage scale on how
charge? We charge a somewhat unique fee in that it declines every year. So it begins at 1.25% and ends at 0.75% annual, and it declines each year as it progresses over 10 years to that point. So we try to reward clients for their loyalty and expect that the portfolio will appreciate over time, and so we should be charging a lower fee.
And then is the financial planning portion of it included in the fee?
It's included. We do not charge additional for financial planning. We make it available to any client at any time if they need it. And oftentimes we revisit their financial plans as we go through time.
Okay. And for full disclosure, I'm one of your clients, so you manage my money as well. Do you sell, are you affiliated with anyone that sells annuities, insurance, mutual funds? Do you take referral fees, anything of the sort?
No, we're independent and independently owned, and all we do is the investment work, and it's just the client that compensates us.
Okay, super. Let's go over introduce Kurt, so that because you guys are going to be making the presentation there as well. Kurt, where's your master's or other advanced degree from?
University of Virginia.
Did you live there?
I did. I lived in Charlottesville for 2 years.
Really?
Yeah.
So that's an experience all on its own, you know?
Yeah, it was great. Great time.
Okay, no licenses because you're a fiduciary, fee only. You work together with John. You're the co-owners of the firm, I understand.
That's correct. We have,
Okay, great.
Four principals at the firm and 3 owners. John.
Tell a bit about your background, Kurt.
Sure. I started my career at PIMCO locally here in Newport Beach. I was there for about 5 years, then went to the University of Virginia, after which after my MBA, I worked for another institutional fixed income manager, and primarily in the municipal bond space, working with high net worth and ultra high net worth individuals. And then I transitioned from the institutional side of the business to the working with individuals in 2012. And have been doing that ever since.
Yeah. And I think your father was in the business for a few years.
He was a couple decades.
Yeah, exactly. So when did he start teaching you about the financial services industry?
The one lesson I really remember was stock market, when I wanted to buy a car in high school and I had some money from summer jobs, and, he helped me pick a couple stocks to invest in, knowing I was going to buy a car, a year and a half later. And
starting to learn
outside of that,
money.
though, he tried not to bring his work home with him too much. So we didn't talk about it as much as you might think.
Okay. All right. John, Kurt, let's get into the program, and it's all yours.
Great. Well, we really appreciate you being with us today, especially under the current conditions in Orange County. Appreciate that you're interested in increasing your investment knowledge. The topic today is equity investing, a better way we think we can explain. And the agenda is in front of you. We'll start with the basics. We'll define what is a stock, the role of stocks in your portfolio. We'll talk about the different investment vehicles, how to research and invest in stocks, some of the risks that may be associated with your current portfolio potentially, and how to conversely do well in the market. So that's what we're here to talk about today.
John,
sure.
I forgot to ask both of you, if somebody is interested in meeting with you, do you charge for that, or will you review a client's portfolio if they want you to review it? Is there any obligation to be with you in order to review the portfolio?
No obligation. Happy to review and provide a written evaluation of anyone's portfolio of any size. Happy to do that.
And incidentally, Pete, just to make sure we even have contact information, that's on the last slide, that they'll review it for free. And here's the contact information.
All righty.
Yes, at the conclusion, we will provide our contact information. Okay, so let's get going. What is a stock? A stock is a share of ownership in a business. And what I like to say is, literally, you own a share of that business. It's not just a piece of paper. And oftentimes the term equity, which is the title of our talk, is thrown out. It's synonymous with the word stock. If you hear equity or stock, it's the same thing. We're talking about the stock market. There are, however, 2 kinds of stock: common stock and preferred stock. Preferred stock will pay dividends and is income oriented, not about appreciation really. Whereas common stock is what you hear, the Dow Jones Industrial Averages, those are common stocks. and it's more about appreciation and sometimes income. So those are some of the basics. This is one of my favorite charts. Oops, actually. Okay. This is one of my favorite charts. It shows the history of the S&P 500 going all the way back to the year 1900. And the first thing I would point out is take a look at the scale on the left side, starting at a level of 10 for the index and finishing today at 3,400. And to put that in perspective, over 120 years, if you had invested $10,000 in the year 1900, you'd have $3.4 million today. And 120 years is, longer than a lot of investment horizons, but it just gives you a sense of how much the stock market has risen over time. And I would say you don't have to be brilliant, you don't have to be lucky to experience this kind of appreciation, which turns out to be about a 10% per year rate. You just need to have a long time horizon that we'll really emphasize today and participate, have your money in the market. And I would say if you take one page from the presentation and retain it, it would be this one. And every time someone's complaining about the election or concerned about COVID or any of these big picture concerns, I would say, look at all the labels on this chart where we've had wars and inflation and deflation and depressions and all kinds of political leaders. The market rises over time because it grows with corporate earnings, and that's what makes it so great. And lastly, I would point out all of those gray vertical bars that you see going across through time, those are all recessions. So we've made it through a lot of recessions, and yes, there's dips, but stocks always come back.
And so when we think about the role that stocks play in your portfolio, I think that slide that John, you just had up there illustrates beautifully the growth component. And most investors are aware of that when you're investing in a diversified portfolio, the engine of growth really comes from stocks or equities. And depending on the index you're looking at the moment in time, whether you're including dividends or not, where you're measuring from, somewhere in that 8 to 10% range is what stocks have compounded at over time. So there's a really strong correlation to the US economy, which of course grows over time. But increasingly, we're seeing investors turn to the stock market for income as well, which used to be reserved primarily for the bond market. But in today's historically low interest rate environment, bonds are failing to deliver that income. And so, John, you touched on preferred stocks, which have always been a source of income for investors, particularly a nice source of income in taxable accounts. But increasingly on the common stock side, you're seeing, dividend stocks being used to augment and supplement that bond portfolio. Also, liquidity is an important component of the publicly traded stock market. Contrast that with, say, real estate, which is an illiquid investment. Publicly traded stocks are liquid. Anytime the market is open, you can, which is most Monday through Fridays, you can go in, and if you need to access your cash, you can sell your positions. There's no lockup like you would have with a hedge fund or private equity. So that liquidity component is a key piece of the market. And then we say a potential inflation hedge. I've given this talk a few times on the fixed income side, which I believe you'll be discussing next week on November 3rd, which should be an interesting conversation. But the reason that bonds are a deflationary hedge, which is what we always say in that presentation, is because you lock in a given interest rate. And so in a deflationary environment, as rates come down, the interest rate that you've locked in is now more attractive. So you're hedging yourself against potential deflation. How do you hedge against inflation? Typically real or hard assets, right? Things like real estate, commodities, depending on the commodity, are inflationary hedges, but stocks can be as well. It is industry and frequently company specific. And really has to do with that company's pricing power. If they have pricing power and the ability to raise prices along with inflation, they will do well in an inflationary environment.
So iPhone is a big winner.
Say that again?
iPhones are a big winner.
They are a big winner. Yeah, that is pricing power for sure. And it's important to understand that, net of taxes and inflation, here we say stocks represent the best way to grow your purchasing power. I would submit in a diversified liquid portfolio, they represent your only way to grow your purchasing power, because real yields on bonds are negative at this point on investment grade bonds. Real yields are the nominal yield, the yield you're purchasing the bond at minus inflation. So before we even get to the taxes on the income, on the yield that you're earning, after net of inflation, if you buy a bond at a 1.5% yield and inflation's at 2%, you're losing purchasing power every year to the tune of 0.5% a year. So once you factor in inflation and taxes, stocks really represent the best way to grow your purchasing power. And when you think about that, for long-term investors who are seeking to secure their retirement, a bond-centric portfolio can be viewed as risky. And we view it that way. For our clients who we're planning for that are retiring in their, say, early 70s in good health, we're planning for them through well into their 90s. That's a long-term investment horizon. And if you over-allocate to the bond market, you inhibit your ability to maintain your purchasing power and grow over time. So that's why we say, viewed through a long-term investor's lens with interest rates where they currently are, investing in bonds is a risk to your financial security.
Kurt, Tarbox Equity was saying that their maximum duration in the bond market for most portfolios that they have is 7 years, and most of their bond portfolio is in 3 to 4 years. What's your client's portfolio looking like in the bond area? And we're not going to go heavy into bonds, but just for curiosity.
Yeah, so we break up the fixed income portion of the portfolio into two pieces, two components. One is stability, that high grade fixed income, and the other is yield, right? So, and depending whether that's a taxable or tax deferred account, the positions will look different. If you think about the stability portion, that's where you're really worried about the interest rate risk because rates are lower, right? It's really what you're investing in there is, at this point with yields this low, you want the non-correlation to the stock market. So it's more of a price play at this point. And then it's the more yieldy portion of the portfolio where you're either taking more credit risk, and it's a high yield corporate bond, or you're in a preferred stock where you get that yield and you're less worried about interest rate risk. So
your duration is?
Duration on our portfolio is in the 5 to 6 range.
Okay.
Yeah.
All right. Let's go to the next slide.
Okay, and I'll just say on the fixed income side, it depends. If it's a client in a high tax bracket and they're in municipal bonds, to achieve a decent yield, the maturities would range typically in the individual municipal bonds between 5 and 15 years, so a little bit longer term. If it's a tax exempt, say a retirement account, and we're buying individual corporate bonds, we can get to the same kind of income level with maturities in the 2 to 10 year range. And so because we're getting that extra corporate bond spread, so it kind of depends on each account and each client.
Thanks, John.
But on the stock side, this slide illustrates the different ways it's possible to invest in the stock market. And you don't need an advisor. If you're interested in the market and stock picking, you can do it yourself. You can buy individual stocks. You can even do it online at places like Fidelity and Schwab. And the nice thing this year that changed, there are no longer really any commissions. So when you buy and sell, there used to be transactional commissions. Those have gone away now, assuming you take electronic delivery of your statements. So you can do it yourself in individual stocks. That's a tax efficient way to do it. You can collect dividends at a low tax rate and you don't have to pay any tax on your individual stocks until you sell them. Alternatively, if you don't want to do it yourself, through individual stocks, you could pick a mutual fund. Mutual funds tend to be actively managed. Active means they're trying to beat the market, do better than an index. And I'm not a huge fan of mutual funds, especially when it comes to tax-paying accounts, because they're very tax inefficient. They distribute their capital gains every year. They distribute all the dividends and you have to pay tax on those. And the fact is, these actively managed mutual funds have failed to beat the market. So you're paying sometimes a large fee for underperformance effectively. Which brings me alternatively to a more recent creation, which are exchange traded funds. Just like mutual funds, it's a collection of stocks in a fund, The difference with these ETFs, exchange traded funds, they tend to be passive. They're not trying to beat the market. They simply provide you exposure to a group of stocks. It could be the S&P 500 index. It could be international stocks. It could be other kinds of stock varieties we'll describe in a minute. They are very low cost, literally almost no cost in some cases, at least the ones we tend to utilize. So we do research here and look for well-built exchange-traded funds, and I'm a fan of them in tax-paying accounts because they basically don't generate any tax until you sell them. Alternatively, back to doing it yourself, you can go to a brokerage firm, full service or online, different kind of brokerage firms. They hold the assets. They hold the stocks in an account for you. You can come to an investment advisor like Knightsbridge Wealth Management, and we will build the portfolios for you, in our case, using a combination of these different vehicles. And lastly, there are variable annuities, which I'll have Kurt maybe share a few thoughts.
Yeah, we've got do not count in capital letters here. And that's because, if an advisor says the term annuity to you, my advice would be to run for the hills. Typically, annuities are not bought, they're sold, right? No one wakes up in the morning and says, I'd like to buy an annuity, right? Somebody makes an impressive sales pitch and you end up buying it. Annuities, we have variable written here, but this would apply to any type of annuity. They're expensive, and most importantly, they're illiquid. And so you remember on the previous page, one of the key tenets of publicly traded equities is they're liquid. Annuities are not liquid. You're typically locked up for a 10-year period and charged very expensive fees in excess of 2% each year, so that the insurance company, it is an insurance contract, can recoup the large commission that was paid to the person who sold you the annuity. You may see index-linked annuities that say, oh, your return is linked to the S&P 500, and that's a stock market index, therefore I'm invested in the stock market. You're not. Those are sold because they typically have three features. A floor, say 0%. They say you cannot lose money in this in any given year because there's a floor at 0%. And then you have a participation rate, so say 50%. So you get 50% of the return of the S&P 500. Okay, but then they have a cap. And that cap could be 9%, it could be 10%. And what that says is once your return hits that level, you cap out and you don't get any more. Well, what's the issue there? If you're not participating in the big 25 to 30% years that the stock market experiences, think most recently 2013, 2017, 2019, you're not going to compound at that rate we talked about, that 8 to 10% rate. You need those big years to make up for bear markets and some of the skinnier years. So I advise you to stay away from annuities. I know Pete would say the same thing and probably has. I think you opened up this webinar talking about annuities. So just wanted to drive that point home.
Yeah, one of the questions I have for both of you is that you put together a person's portfolio with stocks and bond exchange rated funds. How do you determine manage the risk? Let's say someone is in their 70s.
Kurt, you want to take that?
Yeah. Well, so you have to define it. It's not just age. I mean, age is important. There's a couple other factors. One is replacement rate, right? So you could have somebody in their 70s and we're managing, $500,000 for them, but meanwhile, they're still earning $1 million a year. They can more easily replace that investment than somebody who could be in their 20s who's inherited $1 million, but only earns $30,000 a year. They're not going to be able to replace those funds. And then the other piece of it is this portfolio in the accumulation phase where they're adding to the portfolio? Is it static, or is it in the distribution phase where they're taking withdrawals? And all three of those will affect the level of risk you put in the portfolio. And to your point about how you manage the risk, well, it's a couple things. You're looking at what is the risk of the individual positions, right? How are you balancing risk portion of, say, the stock market versus lower risk pieces of the stock market? And then also the bond side. What are you investing in that is in the higher yield portion where there's more credit risk versus, interest rate risk? So risk comes in a lot of different forms. There's recessionary risk, interest rate risk, credit risk, all these different inflation risk. So you want to manage against all of those and make sure that you have asset classes in the portfolio that are non-correlated.
And well taken. An individual investment, if you talk about bond or a stock, you can't just use a generalization and say, okay, this is risky. It's all about putting the pieces together, the pie chart together, depending on what the individual's needs and objectives are. And that's sometimes why when we answer a question that somebody has, it's difficult to answer because we don't know all the facts surrounding that particular question. One of the things is that if somebody is in their 90s and they just want capital preservation, what kind of portfolio are you using for that?
Those would be more bond centric for sure. And, it depends on for a taxable account. Well, let's start with the tax deferred. For a retirement account, we're going to use taxable bonds in addition to we call our managed income strategy, which is a strategy that we have internally at Knightsbridge, where we use the high yield corporate bond market, but we're tactical. So we will sidestep periods like March of 2020, but it allows for an increased yield above and beyond what you get in the taxable investment grade bond market. We'll also have mortgage-backed securities in there as well. And then
it would be a diversified portfolio aimed at lowering the risk of the entire, preserving the principal is your key goal.
Absolutely, but we would still want to allocate to the stock market as well, just be a much smaller percentage.
Okay. There was a question regarding annuities, and I just want to clarify that charitable gift annuities are a completely different animal than the commercial annuity. And usually the commissions are built into an annuity. So you never want to sell an annuity until you're out of the surrender charge. But each individual annuity is an individual contract, and a fee-only advisor needs to review it. You can't make a generalization that say, hey, this is okay to sell, this is not good to sell. So, or exchange. So yeah, you have to review them. John, back to you on the next slide, I believe.
Sure. And Pete, you brought up good questions that later we have some slides that really speak to
Super.
What ultimately is time horizon, and very basic. If it's short-term money, it needs to be capital preservation oriented. If it's longer-term money, it's directed more toward the stock market. And later we'll offer a framework as to how to think about that. Just some more investing basics on the stock market. You may have heard the term style box. That's a way to basically carve up the market into different areas. Two dimensions. The large, medium, and small you see listed there on the right, that refers to the size of the company, otherwise known as market capitalization. When you hear market capitalization, it's just how big is the value of this public company. And market capitalization is stock price times the number of shares. And that's how you get to the size of the company. And so when you hear about Microsoft and Apple, those are nearly $2 trillion valued companies. And those would be large cap stocks. And then you have medium-sized or mid-cap stocks, and then small companies. And the S&P 500 index or the Dow Jones Industrial Average, those are large cap indices and really driven by the biggest companies. Another way to divide the style box is by the style of the stock or the company, from value at one extreme to growth at the other. And you could think of value stocks as companies maybe in a turnaround, or they've struggled a little bit and they're quote unquote cheap stocks today because of that. So when you have a company directly affected by COVID, say a retailer, those are value stocks because they're more controversial and out of favor and beaten up in the lower stock price. Conversely, growth stocks would be your Netflix, your Amazons that are growing rapidly, and they're more expensive today, but projected to grow at a more rapid rate. The key here is the reason this style box was created so that investors had a sense of how to diversify, where to establish exposure. You want some big companies, but you also want some small companies. Value and growth are good to mix because either can be out of favor. Any of these areas can be out of favor for long periods. In fact, the last decade, growth stocks have just crushed value stocks, punctuated by 2020 post-COVID. And so at some point that will probably reverse, and it may be important to own value stocks. So that's the style box for you.
Can you predict?
You know, I'm surprised for how long this has gone on, where growth stocks have dominated. For a while, I expected some reversion in that and value to start to pick up. But once we came around to the idea a few years ago that interest rates could stay very low for a very long time, which they have, it really justifies this advance in growth stocks, because the discounting of those future profits, they become more valuable. And so, you know, my prediction would be predicated largely on interest rates in the economy. If the economy gets stronger and interest rates start going up, value stocks would do better.
Yeah, and you think about a company like Tesla or Amazon, you know, that comes out with a business plan that, hey, we're going to be in the red for 15 years, and then we're going to be then we're going to be profitable. If the risk-free rate, if people can get 6% in the bank and CDs, they're going to laugh at that and they're not going to invest in that company. But when you're getting nothing in the bank, what else is your money doing? It's sitting there. Suddenly, these business plans for companies to just take market share for 10 years plus, and then eventually flip the switch to become profitable, becomes more acceptable, which is, I think, one key reason why these growth stocks have done well.
But in your client's portfolio, diversification is going to be the key, right? I mean, you don't make a big, heavy bet on one style or one particular sector, on large, medium, or small. You may hedge your bet a little bit, but I would assume that you're still diversified.
We like to be diversified. We also like to be opportunistic. And so we will typically establish exposure across this style box, where we have some larger companies, but also some smaller ones, and really try to be diversified.
Yeah. So for the participants watching, is it important for them to know these terms and how they've been investing, or how they are invested today? And where would they find this information?
I think you've reviewed my presentation in advance. We will show just that, some tools, and absolutely it's important to understand what your portfolio looks like, which is why we say, hey, if you've not done that, we'd be happy to tell you what you own. Especially nowadays, when there are more indexed portfolios and ETFs, you may only have exposure to the really large cap or US companies, and we like to think globally. So not just this style box, but on a global basis. And there are tools in a minute that will show you where you can get a quick sense of what you own.
Yeah, let's go to the next slide.
Sure. Let's talk a little bit about investment strategy, how you might pick stocks. First, I'll tell you what not to do. You are not allowed to pursue what's known as technical analysis. It doesn't work. It's basically mumbo jumbo. It's the idea that you can look at patterns, predictive patterns that relate to stock prices or volume. And by looking at a chart, you would have a sense of whether to buy or sell. And I've never met anyone or heard of anyone that's done that successfully over time. I wish it was that easy, but it just doesn't really work. So
if you think about it, for a taxable account, you know, you're realizing those taxable gains every time you sell. There's no chance you're going to outperform, you know, longer term buy and hold. But even in a retirement account where you're not subject to that tax liability, you just have to be right too often. Not only do you have to be right when you sell that the market's going to go down, but then you have to be able to get back in before it rises, which, as John said, to do that consistently throughout time is really improbable.
$3 to $5 billion market on technical analysis.
Yeah, it's crazy.
Amazing.
Yeah.
Next slide.
And in a bit, well, what we are believers in is investing on fundamentals, company fundamentals. And that means you go in and you actually look at the numbers and you study companies and you take a look at valuation. And the goal is to buy below what's known as intrinsic value. i.e. buy for less than the company is worth. And that can mean different things. You can be a value investor, where you're trying to buy a stock today where that price is low relative to the fundamentals today. And you can look at some of the valuation measures we show in item number 3, price to earnings, book, sales, cash flow. You can identify these measures yourself. All public companies are required by the SEC to file quarterly reports, financial statements that include the income statement and the balance sheet. And that's where you go to find the earnings and the book value and the sales or revenue and the cash flow. And or you can go online, and a lot of the research databases, Yahoo Finance, Google Finance, include these valuation measures. But the value investors are trying to buy the low stock price today relative to these fundamentals. The growth investors are saying, well, I'm going to think about today's price and what the future holds. How much will this company grow? How high will earnings get? For how long will earnings grow? And think about today's price relative to those future earnings. There's no right or wrong. Value's not right. Growth or value, can both be successful in different environments. It's really best to go with what feels right to you as an investor. Are you more excited trying to find the next Tesla, or do you think that you're a good contrarian and you're a good value investor? But there are a couple things I don't want you to do. I don't, Kurt mentioned the short-term trading. I think that's very difficult to be in and out of stocks all the time, and better to get to know a company really well and stick with it for the long term, which means you don't need to buy the most cheap stocks. You need to buy good companies that you can hold for the long term at a reasonable valuation. Don't buy IPOs, new issues, initial public offerings. They underperform the market as a whole, and you probably aren't going to have access to buy in before they start trading at the lower prices anyway. And so, my best advice would be to buy companies and hold them for the long term. So here's your answer, Kurt. Pete. This is where you go. You go to the public library, and you can do this online as well as in person, and access 2 research services that are available for free. The first is Morningstar, which would be appropriate if you're interested in funds, the exchange-traded funds or mutual funds we mentioned earlier. There is what's known as a Morningstar report available on all funds. If you know the name or the symbol, you type it in, and it'll give you a 7-page report with a lot of analysis and statistics around the funds. Please look at beyond just the performance results. Look at the tenure of the fund manager, whether they have their own money in the fund, the risk and the reward, just the characteristics of the funds, and you can review all of that at Morningstar at the library. The second is, if you're an individual stock investor, there's a service known as Value Line. We use it here, actually. And what's great about it is if you type in the name or the stock symbol, like I've shown here with Apple, it will pull up literally on one page a relatively detailed history around these company fundamentals. So you'll see year by year how much Apple's fundamentals have grown, how much of their sales gone up, their cash flow, their earnings, the change in the dividends. Really all the basics are just on that one page, and it's a good way to become familiar with a company quickly.
Yeah, I just want to also mention the Orange County Library has the same kind of service. These libraries are just wonderful. So yeah. We encourage you to support them, because you can get this kind of material that would cost you hundreds of dollars, and it's available to you at no charge.
Yeah, and Pete, before we get nasty emails, it is the Orange City.
Orange
Library,
City,
not county.
Okay, I apologize. You're right.
And I'm actually on the board of the Newport Beach Library. And if anyone needs help getting set up to access these reports, just give me a call and I'll point you online how to do it.
Awesome.
Okay, next I'd like to throw out Knightsbridge Wealth Management's 4 principles for buying a stock. These are kind of the 4 most important things I think for you to be thinking about, particularly if you want to invest in individual stocks. The first is to consider risk and reward in that order. Be more concerned about the return of your capital than the return on your capital. I just don't think your way to investment success is to speculate, to be a quick trader, or to try to find these companies that have no profits that you think can become amazing companies. You want good quality companies. And the second is buy dividend paying stocks, a bird in the hand. That accomplishes two things. You get some money back. You get compensated even before you sell a stock. It also leads you to companies that are profitable and probably have a lot of discipline, because every quarter cash is going out the door to shareholders. And so I think dividends are a really good thing. Third, I mentioned earlier, invest at a reasonable valuation. You're not better off buying just the cheapest stocks. It's a combination of value and growth. It's what you pay and what the future holds. So, just a reasonable valuation can be fine. And fourth, buy high quality companies you can hold for a long time with tax benefits. Certainly in our tax paying accounts, that's our approach, to try to emphasize those stocks that we can own for many, many, many years. And, even if the market drops, you don't have a loss really until you sell. So, those are the four principles. I'd say investing in individual stocks takes a lot of time. You have to follow your companies once you own them. And if you enjoy that and you feel capable and interested, great, you can buy individual stocks. If not, you're probably better off either in an index, just own the market, basically it's cost-free, or hire an advisor to do it for you. Those are the three avenues, I think.
You sound like Warren Buffett.
I try to pay close attention.
So, as you're spending time researching, whether it's mutual funds, ETFs, or individual stocks, we encourage you to think about what type of account is this position going to go into, right? So is this going to go into a tax-deferred qualified account, an IRA, 401k, profit-sharing plan, or is this going into a taxable account, right? Which could be an individual account, a joint account, or an account in the name of your family trust. And the reason for that is, if you're choosing investments for a taxable account, this chart, I think, does a nice job of illustrating the difference between, two investors here. They each start with $100,000, and over a 20-year period, they compounded a 6% rate of return. And they're subject to a 30% capital gains tax rate. And so what this points out is investor A buys and holds. That's the dark blue line. That aqua line beneath it, that's investor B, who has a 50% turnover. And if you're on Morningstar looking at funds, they'll tell you the turnover of the fund that you're looking at. A 50% turnover implies that every 2 years you're turning the entire portfolio over, right? You're selling, buying a different stock. Now, if you look at the difference here over a 20-year period, with just starting with a $100,000 investment, it's actually a $160,000 difference in the end for the investor who buys and holds versus the investor who turns their portfolio over 2 years, every 2 years. And, we have this chart going out 30 and 40 years, and it goes exponential, but most people, it's difficult for them to think of a 40-year investment horizon, but 20 years is very realistic. So, this doesn't mean you never ever sell a position, but it does illustrate the point that the longer you hold your positions in taxable accounts, the better you will do.
Is that also one of the reasons why index funds do better or are more tax efficient?
Yes, they're more tax efficient. It's that, but it's also the way they're construed. Open-ended mutual funds to have a share creation and elimination mechanism. So when you buy a mutual fund, they create shares in addition to you. And when you sell them, they eliminate shares. And then when there's a lot of selling pressure in down markets, they're forced to sell out positions from the fund, which forces them to realize gains. And then they have to distribute them. Unfortunately, you could buy a mutual fund, in June of this year and not even participate in any of the gains that have taken place the first 6 months of the year. And then you get the taxable gain distributed to you, the capital gain later in the year. So oftentimes the people who are having the gain forced upon them, the taxable gain, never even experience the actual profit.
So that's where usually you're active, but on a whole, just generally index funds are more tax efficient.
Exactly. Yes, because they're not actively buying and selling as much. Yeah. Correct. But
Let's
it
go
has to do with the fact that ETFs have a buyer and a seller. So when you go buy an ETF, you're buying it from another individual. investor.
Let's go to the next slide.
Yeah. So as we think about, optimizing, the tax optimization of your portfolio, what does that mean? Well, it means quite simply in your tax deferred retirement accounts, that's where you want to put more of your tax inefficient assets. And then in your taxable accounts, that's where you want to put more tax efficient assets, right? So how does that work? Well, at Knightsbridge, we affect this in a few ways. I think many investors are aware of, and most advisors engage in, making a distinction between taxable bonds going into retirement accounts, and for high income earners, municipal bonds, which are income tax free, going into taxable accounts. But if you take it a step further and you think about the more yieldy portion of the fixed income portfolio, where should a high yield corporate bond go? Well, it's probably better suited in your retirement account. And how can you get a higher yielding fixed income like security into a taxable account that's more tax efficient? Look at something like a preferred stock. The preferred stocks that we buy at Knightsbridge, not all preferred stocks have qualified dividends, but the ones that we buy have qualified dividends. What is a qualified dividend? It's a dividend that is taxed as a capital gain. So instead of being taxed at your income tax rate, like you would be on a high yield corporate bond, on a preferred stock, you'd be taxed at the capital gains rate. So it's more tax efficient. On the equity side, on the common stock side of the portfolio, we'll take it a step further. In a tax deferred retirement account, that's where you can be really opportunistic, right? John talked about, here's a stock that we feel has dislocated from its intrinsic value, right? We think it has the opportunity to appreciate meaningfully in a shorter period of time. Well, you buy that stock, it reaches your price target, and you sell 6 months later. There's no tax consequences for doing that in a retirement account. In a taxable account, the taxable gain you generate can be onerous, and you have less proceeds to reinvest. So we prefer to be more opportunistic in tax deferred retirement accounts than taxable accounts. High dividend paying stocks, you can have those in either, but if they're really high dividend paying, they're better off in your retirement accounts. So what types of positions do you look for in taxable accounts? These are positions we call compounders, more long-term buy and hold type of names. ETFs go great in taxable accounts. If you're going to go with an active mutual fund, you want that in your retirement account for the very reason Pete just pointed out. They're less tax efficient. But when it comes to buying individual stocks in a taxable account, you want something you can buy and hold longer term. So we call those compounders. And what does that mean, a compounder? It's typically a company with a high rate of return on invested capital, which means that they have new projects coming online that, as their existing business is generating profits, they can reinvest those profits back into the business at a high rate of return. If you think about a company that has a thriving existing business, but doesn't have the opportunity to reinvest in those new projects, what do they typically do? Well, they get pressure from the board to distribute those in the forms of dividends, right? That's not tax efficient. That's great to collect that cash as an investor, but it's not tax efficient. That's why you want those dividend payers, preferably in your tax deferred retirement accounts. In your taxable account, you want companies that can take those profits and reinvest them in new projects that are profitable. That way you can hold the position for longer and realize the tax benefits from doing so.
So, and you're talking about this, and one of the issues is when you're doing a general class for over 100 different people, everyone has a different goal and a different objective. So if somebody has plenty of income, they don't need any more income, probably you wouldn't be investing in dividend stocks. You could do your portfolio somehow differently. So that's one of the dangers of thinking about investments as good or bad. It depends on the goals, objectives, the risk, of what other income you have, etc. So,
and that's why we don't pool client.
Yeah,
so that we can make each client's portfolio appropriate for them. That's absolutely key.
And that's why you can't have 3,000 clients.
Right.
It has to fit the individual. We had a quick question on define an index fund.
Sure. An index fund is passive. It replicates your investment replicates the return of the benchmark or the index. So the S&P 500 index is made up of 500 companies, And if you buy a passive fund, you're going to get that return of the S&P 500 less the small little fee that the fund charges to construct that index fund. So it should be expected, if it's passive, it's expected to replicate a part of the market. It could be international stocks, small company stocks, the Dow, the S&P 500, but a passive approach is not trying to beat the market, just establish that exposure and take what the market gives you.
Let's go to the next slide.
Okay, we want to touch on some hidden risks that may be in your portfolio, something to think about, especially because if you go online and look at your portfolio or you check your monthly statement, you may not realize some of these potentially hidden risks in your portfolio. The first one I want to talk about is sector risks, sector concentration. The S&P 500 index, which is the primary index for stocks in the US, is today made up of 11 different sectors. Technology represents the largest share at about 25%, healthcare next largest at 15%, and the financial sector at 10%. And there's 11 sectors in total. And it's very interesting looking at this chart going back to the year 1800. The 1800s began with finance being the largest sector, the light green. And later in the century, as the railroads took over, got built up across the country, transportation became by far the largest sector. More recently, in the 1900s, you had other sectors grow up like healthcare, information technology, communications, and we got to this more diversified point of 11 sectors. So if you own the S&P 500, if you are passive, you have exposure to those 11 different sectors. Conversely, if you have a limited number of stocks, you may have heavy concentration in a particular sector. Let's take energy, the risks that you can have from sector concentration. 20 years ago, energy as a sector represented more than 20% of the market. Today, it's literally 2%. All the stocks, energy stocks, are only 2%, probably going towards zero over time. So that's if you haven't looked at your portfolio and run it through that style box, run it through a sector check, you probably should. The second aspect of being overly concentrated is interesting because you may think you're diversified if you own the S&P 500, right? 500 different stocks. However, the S&P 500 index is put together on what's known as a market capitalization weighted basis. The bigger the company, the bigger the weighting. And so this chart illustrates, since 1980, the 5 biggest companies in the S&P 500 have averaged the combined 5 weighting of the 5 stocks, 14%. And then we've reached in 2020 a very high record setting over this period, 20%. And actually, if you look at the top left date, that was back in April. Those 5 companies, Netflix, Amazon, Apple, Google, Facebook, Microsoft, not Netflix. So Microsoft, Apple, Amazon, Google, and Facebook today represent 25%. So if you own the S&P 500 index and you think you're highly diversified, 25% of that investment is in 5 stocks. And that's why we, going back to the diversification, like to own the big and the small cap stocks and things like that through various stocks and funds.
And those are great companies, by the way. It's not a knock on those companies, but when we talk about diversification, those 5 companies have as large a weighting in the index as the bottom 228 companies in the S&P 500. And those are big companies in their own right. These are the 500 largest companies, right? So, and this to me is and from our perspective at Knightsbridge, is indexing, market cap indexing is a great way to build a low-cost portfolio and have it serve as the ballast, perhaps, of your equity exposure, your stock market exposure. But this is why you probably don't want 100% of your stock market exposure in a market cap weighted index.
Yeah. So the S&P 500 is not. If you just own the S&P 500, you're not diversified.
Yeah, not as diversified as we would like.
Yeah, as you should.
Yeah. All your eggs are in the U.S.
Yeah.
And it's a large cap index. There's a lot more. Kurt brought up a really good point I wanted to mention today, and that is the difference between a good business and a good stock. I love Apple. I have too many Apple products in my family. We've made a lot of money in the portfolio owning Apple stock for many years now. We're selling it in tax-exempt accounts. It's too highly appreciated in our tax-paying accounts, but we've recently started selling it in our tax-exempt accounts this year because it's an expensive stock now. When we invested, it was cheaper than the overall market, and now it's much more expensive. So very, and in the same respect, a $100 stock is not better or worse than a $10 stock. The stock price tells you nothing. You have to go back to the fundamentals we talked about earlier. How to prosper in the stock market. I like this chart a lot. It shows since 1980, the gray bars represent for the S&P 500 stock index, the full calendar year return. So all the way to the left, the year 1980, the S&P 500 delivered 26% appreciation. Okay. What you'll notice is there are 40 gray bars, full year returns, and 30 of them were positive. So now we're going to start to set your expectations about investing in the stock market. This is backward looking, but I think you can rely upon it. 3 out of 4 years, 30 out of 40, 75% of the time, the market should be up in a given year. That's historically been the case. At the same time, if you look at those red dots, they represent within each year the magnitude of the largest loss for a time. So the worst intra-year decline was the negative 49%. That was 2008 during the financial crisis. At its worst point during the year, the negative 49%, it was actually, 2008 was down 49% at one point. It closed the year down 38%. That was kind of the worst case. But most years what you see is an up bar, up year, and at some point during the year, there was a red dot that was negative 10 to 15%, on average, a 14% drop. So what we tell our clients is, we think we can put you in a profit position 3 out of 4 years at least, but expect every year your stock portfolio to be down 10 to 15% at some point. But if you don't sell, it's not a loss. It's a temporary loss you don't realize. And that's the whole key, is you can't be trading in and out because you might lock in those losses. So it's just an interesting expectation setting chart about the ups and downs of the market. Another way to think about time horizons and loss potential is to go back to 1930 and look at longer holding periods. So if you were in the stock market for one day, the orange bar at left, this is the probability of a loss. What's the percentage chance you lost money in one day? It's almost 50%. It's basically a coin flip if you're in the stock market for a day. Not a great proposition, really. But when you go out a year, you only have a 30% chance that the stock market was down in any 1 year period. You could pick your start and stop point for 1 year, anytime since 1930. And of all those periods, the 1 year, 12-month mark, 30% of them were declines in the market. And that's why you need to have a long time horizon, because when you get out 5 years, it's down to 20%. And if you have a 10 plus year horizon, you're down to 10%. And what we think about is basically money in the stock market. You should have a 3 to 5 year horizon. If you're going to spend the money sooner than that, you probably don't want much exposure to the stock market. And this chart speaks to that, because these are different periods since 1950. So to the left, the green bar is a stock portfolio. What's from the best to the worst experience for a year since 1950? The best was up 47%. The worst was down 39%. That's a pretty wide outcome distribution. A nice big upside, but an almost equally bad downside in 1 year. But what if you have a 5 year holding period? Well, all those losses go away, and the worst 5 year loss was 3% in the green 5 year bar, and it gets better as you go out 10 and 20 years. And if you're a 20 year holder of stock at any 20 year period since 1950, you made money, right? Your worst experience was you made 6%, and your best was up 17%. So this is why it's all about your time horizon, and you want to have money in the stock market if you have a good time horizon to take advantage of that.
So those individuals who are doing day trading, they're using the market for gambling.
Yeah. And it's going on right now because people are bored at home and the sports weren't around. So they gambled in the stock market.
And that's not investing.
That is not investing. And I'll tell you why, because of this chart. well, I'm sorry, I'll go straight to this chart. When you speculate, you can easily lose 50% of your money. Do you know what subsequent return is required if you continue to invest after you lost 50%? This chart provides the answer. If you're down 50%, you need to subsequently earn 100% because you're left with less capital to continue investing, just to break even. So these are the probabilities with whatever loss. So let's say you're down 70% all the way to the right. What do you have to make to break even? 233%. It's punitive math, and so you want companies that are profitable, that have a bit of a track record, and you don't want to be speculating in the market. The other thing I like to point out is how compounding works. If you buy stocks and you reinvest your dividends, this is the rate of return out of the stock market for different periods. 1 year, the green bar of stocks, 7%. 5-year cumulative, 42%. And after 20 years, 301%. If you think about going from 5 years with a 42% return out 20 years, holding 4 times as long, you're not multiplying 4 by 42 and getting 160%. You're making 300% historically because of that compounding, making money on your money. It's very powerful.
It's huge. It's just amazing, the magic of compounding. I read a statistic on Warren Buffett that 95% of his wealth today he gained since he was 65 years old, because of that compounding. And I get a lot of participants who come to the workshop and they go, I'm 65, 70 years old. I can't make any money. Well, I think, when you're 65 and 70 years old, the likelihood of you living to 90 is pretty good. And look at the kind of gains that you could have in your portfolio.
That's right. And particularly for an IRA account holder that's taking the minimum distributions, they're drawing, maybe 5 to 10% per year out of their account. That leaves 90+% available for a meaningful investment horizon.
Yeah. Compounding is just amazing.
So, there's a lot of discussion around active versus passive management, mutual funds. Should you be investing in mutual funds, ETFs, or individual stocks? Growth, should you invest in growth stocks, which have had a great run? Or is it going to mean revert and you should be shifting towards value? At the end of the day, there's really 2 questions that will determine your results as a long-term investor. And the first is, what percentage of your portfolio are you allocating to the stock market? Doesn't matter if you're hiring an advisor, doing it yourself, passive, active, growth, value. What percentage of your portfolio are you allocating to the stock market? And do you capitulate and sell during a bear market? Did you sell during March of this year? Did you sell during March of 2009? Did you sell during March of 2003? And we put October of 87 there so you don't think that the bottom of the market always happens in March. But, at the end of the day, look at this chart above. This is a brutal 20-year stretch as 20-year stretches go in the market. This is 99 to 09, right? 250% bear markets in here. But the S&P still returned over 6% annualized over that 20-year period. And look at the middle bar, the light blue bar, bonds did very well, right? Declining interest rate environment, bonds annualized at 5%. So it makes sense that the green bar, a diversified portfolio of stocks and bonds, would be right in between there, between 5 and 6%. But how did the average investor do? Look all the way to the far right, that dark purple bar, 2.5%. You say, how is that possible? Well, it's because it's timing. It's when they bought and when they sold. It's human nature, right? Psychology. And so you think about, a lot of times we get asked the question, what percentage of my portfolio should be in stocks? What should be in bonds? At the end of the day, if you've got a 5-year horizon or greater, and you're not taking distributions from your portfolio, the percentage of your portfolio that should be in bonds is the minimum amount required to prevent you from capitulating and selling during the bottom of a bear market. And for some people, that's 20%, and for some people, that's 50%. But whatever level of bond exposure you need to hold your stocks through the tough times, that's what's appropriate for you. And so, you think about it, I think it's we're in Orange County, right? Everyone loves real estate here. I think there's a section of the Orange County Register called real estate, and then there's a subsection called business.
Yeah.
Business is a subsection of real estate in Orange County. And part of the reason for that, I think, is because investing in real estate forces people to become long-term investors, right? I mean, no one in March of 2020 was like, oh, I got to run out and sell my house, right? It's a huge pain, right? There's transaction costs. You got to pay a real estate agent, and then you've got to go into escrow. You've got to list it. You got to pack up all your stuff. You got to go find a new house. If you had to do all that with your stocks, you wouldn't sell those either. You just hang on to them like real estate and say, oh, I hope it gets better, right? But the fact that trades are now free at brokerage firms, and that button's right there. Anytime the market's open, you can click it and sell. That's why people tend to, oftentimes, when I see they prefer real estate, it's not because the returns are higher. It's because they do better in real estate because it forces them to become long-term investors. So what we encourage our clients to do is to think about the stock market with that same long-term lens.
One of the advantages of using a fee-only fiduciary advisor, I believe, is that it prevents you from making that mistake. It allows you to hang in there to talk through a downturn in the market. It prevents that big mistake and that assurance that you can talk to someone about your money that doesn't have an interest whether or not you buy and sell. They're just give advice as to what is best for you. And making that big mistake is huge, especially as you get older.
Completely agree. And so, we're big on, recommendations for individual investors. Track your results, understand how you're doing, and track your results net of fees. If you work with an advisor, they should be reporting your fees. And if they don't show you your fees, ask for them, ask for your returns net of fees, not before fees.
So should it be total return?
Yeah, total return.
Total return, net of fees and after tax.
Correct. And then think about your after-tax results. Most people dip into a different bucket to pay their taxes. And if they have that money in the bank, they prefer to do that, which is a good thing to do because it leaves your investments to compound. But if you were to pay the taxes out of the investment account, that shows you what your after-tax results are. We're at Knightsbridge, we're dogmatic about evaluating after-tax results because the highest pre-tax return is not necessarily the same as the highest after-tax return. Compare your results against a benchmark. We intentionally use the term benchmark, not index, because an index isn't appropriate for everyone. And everyone, even if it is, it's not necessarily the same index. If you're only investing in large cap US stocks, maybe the S&P 500 is appropriate for you. But if you're investing in international stocks, you probably want to look at a global index. If you're somebody who takes distributions from your portfolio and you're looking at goals-driven investing, you want to clear a certain hurdle rate, provide a certain level of income, you probably should be looking at a percentage return. It's more so than an actual index. So identify that appropriate benchmark and compare yourself to it. And then, think about an appropriate time frame. We like 5 years, but minimum of 3. As you think about fees, we're big on controlling what you can, right? What can you control? You can't control what the market's going to do, but you can control taxes and fees. So those are the two big themes here, right? And so this table shows you over time what's gone on. Fees have come down in the investment business, and who's the big winner? You are, the investors are. So this is a great trend. I mean, I'll tell you at Knightsbridge in our tax optimized portfolios at this point, our average fee all in is 3 basis points that we're paying, 0.03%. You say, how do we do that? Is it all just passive indexing? It's not. It's a healthy amount of passive ETFs, but we build around that by not paying for active management. We affect the active management. We have CFAs in-house. We will have the ability to go out to bid and buy bonds directly. So we don't have to pay for a fixed income mutual fund that at this point, if a bond fund's charging you 50 basis points and the yield on bonds is 1.5%, you're giving them a 30-year return, right? So the ability to buy direct, and then the ability to find and identify high quality companies and portions of the market where we don't have to then go use an active manager. So that's how we go about it. We're heavily focused on minimizing taxes and fees for our clients. clients.
One of the things I want to mention too is that most of the fee-only fiduciary advisors here in Orange County really do a great job of giving you quarterly reports, and you guys do the same. You're awesome, but almost most of the brokerage firms, you can't understand their reports. You don't get an after-tax return. You don't see commissions, or any return.
Yeah.
The performance review for that alone, I appreciate fee-only fiduciary advisors.
Yeah, I completely agree, because I would say the majority of the new clients we get come from the wirehouses, the brokerage firms, the Merrills and Wells Fargos. And
yes,
I know this is being recorded, so hopefully I don't get in trouble for saying that, but it's just a different business model. And yeah, they typically don't show your return. They just show a dollar balance go up or down.
Yeah, exactly.
So,
continue.
Just a couple more things to talk about here. I think, I'm passionate about this business and transparency and sharing with individual investors, how to identify a good advisor to work with, because there's a lot of them out there. There's a lot of not so great advisors. And here's a couple things you should be looking for. If you work with an advisor, are they differentiating between taxable and tax deferred accounts, right? Just open up your statements. Do you hold the same positions in your IRA that you hold in your trust account? That's a red flag. Do you hold mutual funds in your taxable accounts? Because you should. You should be skewed more to ETFs. And if advisor's going to invest in mutual funds, they should be in a retirement account. Failing to manage taxable accounts in accordance with your tax bracket. We see this all the time. Client comes in, $150,000 a year in income, and they own a bunch of muni bonds in their taxable account. Why? Because, sticking it to Uncle Sam is fun and sexy, and who wants to pay, tax-free income? It just sounds amazing, right? But you're better off if you earn, as a joint couple filing a joint tax return, if you make, depending on where yield curves are at any given time, but certainly if you make under $300,000, you shouldn't own muni bonds. You probably need to get closer to $400,000 before it's worth it. So take a look at that. We also see the reverse, high income earners in their taxable accounts who don't own municipal bonds. So think about that. Do you own preferred stock in a retirement account, or is it in a taxable account? Do you own it at all? And is your advisor actively trading in your taxable accounts, realizing taxable gains, right? We think back to that chart we showed you. Buy and hold is going to outperform over the long run. So look for those things when you're thinking about taxable versus tax deferred accounts. Number 3, are there a bunch of high cost mutual funds in your portfolio? Should you be paying an advisor a fee to go out and buy a bunch of high cost mutual funds where they are paying other people, effectively outsourcing the investment management? Take a look at the mutual funds. Look them up on Morningstar. What are the expense ratios on those mutual funds? Number 4, lacking the expertise to offer in-house strategies at no extra cost. Again, are they all mutual funds, or are there some nice passive low cost ETFs that are complemented with active, some individual stocks, some individual bonds that build around that for the active portion? Or are they layering on fees with expensive funds within your portfolio? Are they charging you a fee for financial planning? A lot of advisors do not charge for financial planning, so seek that out. If they do charge, go for one that charges hourly. We do see advisors that tack on extra annual management fees for financial planning clients, another 25, 50 basis points. If you have a $500,000 investment portfolio and you get charged an extra 50 basis points to be a financial planning client, not just a money management client, that's an extra $2,500 a year. That's cost prohibitive.
It's almost in the reverse. When you go out and buy a Mercedes, because of the high prices, you expect higher quality. In the financial services industry, it's the complete opposite. The lower priced are your better quality planners, and you're going to get better advice. It's just an oxymoron. Just because you're paying them a higher price, you're probably getting lousy advice. Go on. I had to butt in there.
Yeah, no problem.
We've got like 3 minutes left.
Yeah. Okay. So number 6, do you receive clear statements showing your percentage return net of fees? We were just talking about this. Is it gross of fees? Does it not have a percentage return? Is it just a dollar movement? And lastly, failing to personalize your portfolio. Look, the reality is all advisors say that they personalize or customize their clients' portfolios, but the significant majority do not. And why? Unless you have robust internal IT systems and rigorous processes in place, it's just not scalable. It's not scalable. And so what ends up happening is they default to, well, we have these models and we'll put you in one of the models and then we manage the models and you get managed in accordance with that model. Well, if an advisor has 6 different investment models, what are the odds that you and your unique needs fall into one of those 6? Probably pretty low. When
you mentioned that, I always think of Ken Fisher. They slot you. They are fiduciaries, but they slot you into a portfolio. Anyway, we got a couple of minutes left.
Gentlemen, we're going to have to hurry through it because I want to give time
so we'll
to
just
have
wrap
you
up.
slide up.
Yeah. So wrap up. What makes us unique? Who are we? We're independent, fee-only fiduciary. We're a 100% employee-owned firm. What does that mean? It means we're not part of a larger organization where we are, a DBA and we are beholden to the larger firm.
Kurt, go to your your page where they could contact you.
Sure. Go ahead. It's the next page.
Yeah, there you go. That's what we're going to see.
We've talked a lot about taxes. If any of you are interested in, understanding, is your portfolio tax optimized? We're happy to give you our thoughts. There's our contact information.
That no cost, no obligation.
No.
How many clients do you have?
About 300.
How many are you? How many people?
7. 4
What's your total portfolio worth?
4 on our investment team. A head trader takes our portfolio management team to 5. We manage between $350 and $400 million.
Okay,
super. Good facts. All right.
There have been several questions along the way, and that's why I wanted to make sure we had a little bit of time to leave this one up so people can write this down. That are asking questions in terms of what should I do with this? What should I do with that? And I've told them, hey, send it to you because I know you're offering a commitment-free portfolio review. Yeah. And so hopefully they'll be able to follow up. But that's why I wanted to make sure we had plenty of time for this slide as we went through to the end. So
yeah,
thank you.
Recommend any books for somebody who wants to do it on their own?
If I forget the name and call it Investing for Dummies and don't really call it Dummies, do you have any other book that might be recommended that humans can read?
I don't know of too many, walk on.
You're talking about sorry, are you asking?
Define terms. I need definitions of terms. Where can I find that?
Oh, Investopedia is probably the best way to find.
Okay.
There you go.
Investopedia. All right. Very good.
Okay. I think we answered all the questions.
Yes, we did.
And John, Kurt?
I've got a book recommendation, Pete.
Okay.
Simple Wealth, Inevitable Wealth. It drives home the point of, why you need to be in the stock market if you're a long-term investor.
What's the name again?
Helps people think long-term.
Name?
What's the name again?
Simple Wealth, Inevitable Wealth.
Okay. John?
Thank you very much, gentlemen. Appreciate it.
Thank you.
Thank you.
All right. Good to see you all.
Yes.
Take care.